What's up, everyone? It's Josh, the Unconventional Money Guy. Welcome to another episode of Unconventional Money Moves. Been working on getting some more guests. Just recently had a little baby a few weeks ago. So been working towards getting back to some sort of routine. This episode today, just want to come on and talk about the investment world and things that have been going on. I've actually been reading through Warren Buffett's old shareholder letters that he sent out, and I'm finding something very interesting. In the late 70s, early 80s, there was times of high of inflation, and something I stumbled across that Mr. Buffett spoke about is inflation is man-made. Perhaps it could be man-mastered. And what he means by that is prices are always going up. And if we're not keeping up minimally with those prices, we're going to continuously lose purchasing power when it comes to investing. So if inflation's at 5% and you are making a 5% return on your investments, you're going to feel richer because your money's increasing in value. However, if you could purchase one hamburger today and the price of that hamburger also goes up 5%, you could still only purchase one hamburger. So you're running into this situation where your money is increasing in value and it is giving you a false sense of your wealth increasing because the numbers are getting higher. If we see our bank account, we have $1,000 and 1,000 turns into $2,000, we're going to say we have more money. The thing is, if prices are going up and our money's going up, our money has to increase faster than what prices are going on. So right now with investing, and what we need to do in terms of seeing where things want to go is we need to make sure that we are doing better than what inflation is. Because if you sell investments and you take out the real rate of return, such as inflation or any taxes that you may pay, it's actually going to bring down your real rate of return. So this is where a lot of people go wrong, is that they end up getting too conservative with their money, especially as we approach retirement. And with people living longer now, all of the old advice hasn't really been updated to reflect how long people are living and how much we actually need to make sure we stay invested when it comes to retirement. The thing that people are going to look at is as you get older in age, you need to decrease the amount of risk that you take. However, a lot of people don't take into consideration the total amount of risk that they're taking. So for example, if you are going to be receiving Social Security as a retiree, we need to look at Social Security as a huge bond. That's a bond that's going to pay you as long as there's money to be paid. And that's going to give you some sort of stability when it comes to your income, especially if you stop working 100%. The remaining money needs to be invested to outpace inflation. So if you're someone who invested heavily in bonds the last 12 to 18 months and interest rates goes up, what that does is it causes your bond prices to decrease, which is going to force you to have to hold those bonds, sell them at a loss, or you're just going to be holding them. So when it comes to making sure you're invested correctly, you got to keep looking forward. And with investing, you got to ensure that when you take risk, it's calculated risk. So if the stock market, for example, was to decrease by 20%, do you feel like adding money into the stock market would be less risky than not investing in the stock market? It's crazy. And a lot of psychology is with this. It's like if gas prices were to go down, you'd be happy. But when it comes to the stock market going down in value, most people get sad because they're like, oh no, my accounts are going down. It's going to continue going down. It's going to just go all the way to zero. But that's not really the case. Just like there's good times, there's also the bad times. So we have to make sure that we stay in the game long enough to get through the bad times so that we can get to those good times and then see the results that we want to see when it comes to investing. So when the stock market started not performing well, you want to shift your focus and look at where you can buy good companies at a fair price rather than a company that you see might be a bargain, but in the long run isn't really going to be a company that you want to invest in, because the stock market in the short run is a voting machine based on popularity. So you're going to see things such as like NVIDIA recently went up a lot. So, I mean, that's going to be like a hot company people are going to start looking at, versus a weighing machine in the long run, meaning some companies aren't going to give you those sexy returns of 50% in a year. However, they're going to give you a reasonable rate of return. Maybe it's 8 to 12% per year. They pay a dividend. You buy them at a fair price. And then over the course of time, their profits increase, and you can ride the wave with those investments and see your investments and your overall net worth appreciate over that amount of time. There are going to be times where you do maybe want to take that sort of risk. In the beginning of Warren Buffett's career, he invested in companies that were considered to have one last smoke in it. So if you get a cigar and you're down to like the end of it, you have one last puff. So he would look into those companies so he can get a, one last puff before he, changes and puts his capital in the other places. There are going to be opportunities like that. And you got to make sure if you take those opportunities, if it goes one way or the other, it's not going to be detrimental to your long-term wealth. And in terms of looking for those opportunities, you want to make sure that you are considering all of the factors. It's like, hey, can I take this risk? If it goes one way or the other, what's my exit strategy? What's my, add more capital strategy? All of these factors need to be taken into consideration when it comes to investing. And in addition to that, when it comes to looking for those companies, sometimes you can just sit on the sidelines and gather your thoughts when it comes to what you want to do. You don't have to always jump in. Cash is a position. Companies have cash. You should have cash as well. And the cash gives you the freedom of choice to take your time, making sure you are thinking clearly when it comes to making decisions, rather than being reactive all the time. It's like, hey, get in, get out, get out, get in. That's definitely not what you want to be doing. And it's going to end up working against you in the long run, because trading is actually hazardous to your wealth. The people that typically do the best just buy, they hold. And if you look at the long-term outlook of the investment world, it doesn't even look like there's been any bumps in the roads. It just looks like a exponential curve. Unfortunately, in the short run, investing can be scary, because in the short run, when you first start, you're not gaining the beauty of the compound interest where your money starts to make you money. And that takes time to develop. And a lot of people don't realize how tough it is to remain patient. And unfortunately, things take time. You could start investing and you could have an excess return and get really fast returns, but you want to stay in the game long enough so that your money is making you money with the compound interest. It's one of the most powerful forces in the world. And Warren Buffett, 99% of his wealth was created after the age of 60 due to compound interest. So if you need money from accounts, take it gradually. Don't be jumping off a bridge or pushing the red button or anything like that. Stay in the game. Make sure your strategy is going to allow you to outpace inflation, because if you're not outpacing inflation, you're going to get the false sense of security that your net worth is increasing in value, which on paper it is going up. However, you will then find yourself in a world that you don't understand, and you'll be that person that complains about the price of gas, the price of the air we breathe, the price of everything. And you don't want to end up being that person, because in our younger years, we always see that person in the grocery who literally tries to haggle with the cashier and is like, man, everything's so expensive. And you just kind of look at them as like, these are the prices. And you have to make sure you are setting yourself up for future success in order to ensure you don't turn into a complainer about the prices, because what are we going to do about it? There's nothing we can do. We have to make sure we are moving forward and putting ourselves in a position where we can be successful and that we can succeed. So that's what I got for you today. I look forward to having more guests on the Unconventional Money Moves podcast. Thank you for everyone for listening. We'll see you next time.